Okay, welcome back. This is part two of the rundown of the Japanese yen, and we're going to be talking about the conditions for a reversal in dollar yen. For those who don't know, we've been buyers in dollar yen since 110, give or take, back in 2021. And today the market hit briefly 160. I want to talk about the implications of that, and really in the last video I talked about the bank's balance sheet and what is likely to happen in terms of shrinkage over the coming years, how long it could take to present that, and obviously, given that the banks basically called time on the yield curve control at the recent March meeting, what that means. And obviously, to be sure, at the latest meeting, the bank indicated that it will continue to buy JGBs, it will continue to purchase them with broadly the same amount as before. So, well, that's referring to the 7.6 trillion of purchases in recent months. Not quite year to date, but over the last few months. And of course, we're still waiting on, scheduled of planned bond purchases going ahead, and there'll be a range. So let's jump into this a little bit further, with the market obviously pulling back today a fair amount. The yen is now at a 34 year low. There are a lot of people who perhaps see now value in the yen, although it might be too soon to be jumping on the bandwagon as a long-term investment. And as a currency trader, it is very rare to actually get a currency that is seen as an investment rather than a trade. So let's look at the sort of headlines and jump in a little bit further. As we know, it's been outlined in the last meeting. Purchase plan for this month, for April, as we're coming towards the end, it has seen a pretty large or pretty sharp reduction in purchases relative to March. March was a record month, which is quite unusual, because we know that the Bank of Japan often adjusts its actual purchases, but changes to the purchase plan usually are very minor, very small. So that is kind of interesting. If you read between the lines, the key point here is that, in recent months, the midpoint of the bank's purchase range has been actually a pretty poor indicator, a pretty poor guide to actual purchases, because they've been all over the place, up, down, so we can't really draw anything from that. And generally we've been well below that plotted midpoint. And as it happens, the midpoint of planned purchases for April is only a touch below the 6 trillion the bank bought back in Feb. So it's kind of interesting to see where we're at. If we're looking ahead at this rate today, 156.5, down from 160, even if the Bank of Japan, didn't lower its JGB purchases any further from now, the holdings of Japanese government bonds would still have peaked, and they'll begin to shrink, in my opinion. So in absolute terms, the bank is still buying just slightly more than it did in 2021. And that's on sort of just as the pandemic came along, on the eve of the pandemic, really. So that, you have to think about what that means for redemptions on bond portfolios. Are now going to be much higher because the holdings have continued to rise in recent years, and that just comes with the territory. So, and then more importantly is, even if the bank, doesn't lower JGB purchases any further, as I say, these holdings have to shrink. So for me, I would be paying attention to that. Admittedly, the Bank of Japan is holding now at least a larger share of government bonds than almost any other central bank did at any point since the global financial crisis. So if the current pace of bond purchases was maintained, then it's likely that the holdings would fall by less than 2% per annum, which is a very small drop. It's not enough to make a dent or to see any uplift in the currency. And without any further decline in purchases, then the holdings would soon stop falling again, as the bond redemptions would clearly shrink. So to what extent is the bank willing to reduce its holdings? And that very much will depend on whether the bank believes that bond sales will push up bond yields. And it's a difficult question to answer at this point. As things stand today, or right now, the Bank of Japan seems to believe that reducing its balance sheet will indeed make a difference. We've had the governor recently argue that the bank's huge bond holdings are having a huge impact on long-term interest rates, and that can't be ignored. They were saying, one motion for scaling back the balance sheet, is likely to happen. You've got tightening in order to cool activities, economic activity, and help the bank to meet its inflation target. But it's looking like inflation is here to stay longer than perhaps anticipated. Who knows how long it will take to settle below 2% over the next couple of years. Tightening, won't be really necessary for now. I know the whole street disagrees with me on that, but we shall have to wait and see what happens there. Secondly, another motivation would be the concerns of the central bank's financial health. After all, if Japanese government bond yields were to tick up higher from here, the actual market value of the bank's holdings would decline on paper. So in principle, the bank could prevent that, but prevent having to record large losses on the holdings that they have by selling them when the yields are still low, which they could be now by historical standards. If people believe that they're going to tick up, it might be worth them offloading them at this point. It will save them a much bigger paper loss at least. However, as I've said before, it's the Bank of Japan, when they record their bonds and you look at the cost of its balance sheet, it means that the falling bond prices, the impact is not massive unless the bank decides to outright sell. So we have to wait and see. In the long run, these high yields could also improve the profitability of various financial institutions in Japan, as the pension funds, even insurance companies could earn much higher returns on their bond holdings, and banks would be able to charge higher fixed rates. Note that a lot of the fixed mortgage rates in Japan are priced off 10-year yields currently. So that long run benefit needs to be seen in the context of potentially a large one-off valuation losses if the bond yields surge. So this is just a quick update on where we're at today. We've seen a lot of retail traders trying to call the top on dollar yen all the way from 135. Personally, I think this is a bit of a melt up. Things have got a little bit overextended and stretched. We're still long and we still maintain further upside targets, although we are getting more cautious at these price levels. I will do more videos. If you guys find this helpful, let me know. We've been currency traders for a very long time. We trade emerging and developed. We incorporate credit into our trading. I hope this video helped you. If it did, give it a like and share it, please. Okay, thank you everyone.